A lot of people think that if you do this, then your credit score is going to go like this. But are they actually right? In today's video, we're going to find out. And if anybody from American Express just saw that, I'm sorry. Hey everyone, it's Mark. I'm here to help you put more money in your pocket through credit cards and smart financial habits. If that sounds good to you, then do me a quick favor and click on the like and subscribe button down below. Then be sure to check out the links down below in the description area to apply for a new credit card, to get 2 free stocks from Webull, and even some more cash back. A whole bunch of cool stuff is down there, so be sure to check it out. Now today we have a big question to answer. And here it is. Does closing a credit card hurt your credit score? And I'm sure there are many people who would appreciate an upfront answer in this video, so I'm gonna give it to you right now. The answer is yes, it can. But depending on your situation, it may not matter. Now, for the rest of you out there who would like to learn more about your situation and whether or not canceling a card would have a big effect on your score, be sure to stick around for the rest of this video. And we're going to kick things off right now with some credit score basics first, because when you cancel a card, it will directly affect some of these factors that we're about to talk about. So pay attention. If you've already heard this stuff before, I'll keep it as brief as possible, but still make sure that you get a nice review or summary of this, because as we move along, it will be a huge factor in helping you identify your specific situation and then how big of an effect a canceled card may actually have. Let's go. We'll first begin by reviewing the 5 major factors of your credit score. And the easiest way to remember that is with the acronym PHURLEMINA. Each of the 2 letters that make up PHURLEMINA represent one of the most critical factors in driving your actual credit score. PH is payment history, which makes up 35% of your overall credit score. UR is utilization ratio, making up 30% of your credit score. LE is length of credit history, which is 15%. The mix of accounts is 10%, and new accounts is also 10%. In short, the longer your payment history, the better your score. The lower your utilization, or in other words, the lower percentage of your total credit limits that you use, the better your score. The longer the length of credit history, the better your score. Having a few different types of credit or financial products on your credit report tends to help your score. And not opening new accounts frequently, or at least not having very many of them on your report at any given time, also helps your score. Now here's what happens when you cancel a card. With regards to your payment history, well, you'll lose that, and that will likely lower your score. With respect to your utilization ratio, it will then increase when you cancel a card, and that will likely lower your score. The reason for that is because if your spending habits remain the same, let's say you're spending $2,000 a month and you used to have $10,000 of credit across all of your cards put together, then 2,000 divided by 10,000 is 20% utilization. But if you close a credit card that had a $2,000 limit and now you only have $8,000 left over, then you're now going to be using 2,000 out of 8,000 total credit, which is 25%. And the higher the utilization, likely the lower the score. Next up, we have the length of credit history. This will then decrease if you cancel a card, and that will also lower your score. And that's because if you had a track record of positive payment history over a period of time, you will then lose that track record and will no longer be a helpful factor in your overall credit score. Then for the mix of accounts, which represents the different types of financial products you have on your credit report, this will likely have little to no effect if you cancel a card. It may be a bit more dramatic of a score drop if you only had one card and then you cancel it and now you have no cards at all. However, even still, it's only 10% of your overall score. And then lastly, we have new accounts. This will have no effect at all because again, it refers to opening new accounts, not what we're doing, which is closing a card, and that's the exact opposite. So our focus really is on the first 3 factors now outlined in yellow. That is your payment history, your utilization ratio, and the length of credit history. Adding all 3 of those together represents 80% of your overall credit score. And canceling or closing a credit card directly affects all 3 of those. Now, in case this is starting to sound a little bit scary, don't worry about it too much, because here's what's really going to happen. And by that I mean nothing will actually happen for 7 to 10 years. Really? Yep, and here's why. Closed accounts in good standing remain on your credit report for 10 years and will continue to help your credit score during that time. On the other hand, closed accounts in bad standing remain on your credit report for 7 years and will continue to hurt your credit score during that time. So even if you close a credit card today, it won't have any effect today, but it may have an effect several years from now. However, closing a credit card does not affect everyone the same way. And to explain this in a very easy, straightforward way, I created a nice visual for you all that does rely on the earlier credit factors that we discussed. So I'm going to put the visual up on the screen right now to go over 3 main scenarios. And as we go along, pay attention to which scenario represents your situation the best. We'll start with scenario number 1 in red. This is where you have less than 2 years of credit history and have a small amount of credit compared to how much you spend. Scenario number 2 in yellow is where you have 2 to 4 years of credit history and have a moderate amount of credit compared to how much you spend. And scenario number 3 in green is if you have 5 or more years of credit history and have a large amount of credit compared to how much you spend. So with these 3 scenarios outlined, let's see how closing a credit card may affect each one. For scenario number 1, canceling a card may hurt you the most. For scenario number 2, canceling a card may hurt you a little. And for scenario number 3, canceling a card will likely have no effect. And this plays directly into those credit factors that we mentioned earlier, because if you have a long credit history, basically more years worth of credit building on your credit report and more total credit allocated to you, then by closing out one of your cards, it won't have that much of an effect because you already have such a robust credit file already built up. On the other hand, if you're in those early stages of building credit, then your credit score itself will be very, very volatile and sensitive to small changes. I've even had people come to me and say that their score dropped 20, 30, 40 points from simply applying for a new card and getting one new inquiry on their credit report. And as crazy as that sounds, it's almost always when people are within their first few months of building credit, and if they end up getting approved for the card and continuing to use it responsibly, building up a longer credit history, keeping their utilization low, all those types of things that are geared toward building a healthy credit, then their scores rebound very quickly. And then for someone like me who's been in the credit world for a number of years now, when I get a new inquiry, my score might drop 2 or 3 points, or if I cancel a card or my utilization gets higher or whatever it may be, again, the changes are much, much smaller. And the same goes for canceling a credit card because that's also a change to your credit report. So in short, the more robust your credit score is, the less of an effect that other changes will have to it. So with all that in mind, now let's talk about when canceling a card could make some sense. First of all, if your card has an annual fee and you don't want to pay it anymore, you might want to cancel. Second, if you're in a difficult financial situation and you need to carry a balance for a period of time, but the interest rate on your card is really high, you may want to consider canceling and getting a different card that has a much lower rate, or even better, an introductory rate with 0% APR for a given period of time. Number 3, if you're consistently overspending, 1-800-DAVE-RAMSEY. And number 4, if you have too many cards for you and it's stressful to manage them. Any of these situations may be a good reason to cancel one or more of your cards. But on the flip side, here's when keeping a card open makes sense. Number 1, it's the oldest account on your credit report. Number 2, it has a large credit limit. Number 3, you only have 1 to 3 cards total, so closing one could have an outsized effect on your credit report. And number 4, you no longer use it for spending, but you value the benefits. So once again, the majority of these play into the different credit factors that we covered earlier in this video. The first one refers to the length of your credit history. You usually don't want to lose your longest or your oldest account. Number 2 plays into your utilization, because if you have a card with a really large limit, that can help keep your utilization down. And number 3 plays into a couple factors. The first one being your mix of accounts, and once again, also into your utilization, because if you have multiple cards, that means you have multiple credit lines, and all those lines added together can help you have more credit to drive down your utilization. Then you've got the fourth one down there at the very bottom referring to the benefits, and that's oftentimes the case with certain airline or hotel cards where you may not use them on a day-to-day basis for your regular spend, but you value things like early boarding, free jet bags, elite status, room upgrades, things of that type. So keeping those types of co-branded travel cards open can really help make a better travel experience for you, even if it's not a daily driver. Now, what happens if you're in a situation where you've got some cards that you really want to cancel, maybe because they have annual fees or high interest rates or benefits you no longer want to use, but you also don't want to cancel the card because perhaps you're in your early phases of building credit and it may have a larger effect on your score. Again, not right away, but you're looking a few years down the road and you want to set yourself up to be in the best position possible to build a strong, healthy score. Well, fortunately, there are some great alternatives to canceling your cards, so let's take a look at a few of those right now. It's time for a new green card. To begin, if the card has an annual fee, you can ask the bank for a retention offer or to waive the fee entirely for the next year. That way you essentially buy yourself another 12 months of time to keep the card, keep building your credit score, and using the perks, benefits, and rewards. Second, you could consider a product change by asking the bank to switch your card to another card product. This usually keeps your account open and all other factors intact, but you'll have a different card to use going forward. Usually when you call in to have your card upgraded to a more premium, higher fee card or downgraded to a lower fee card, all the positive history that you've built with that card account stays with that card account. And remember, your actual account is represented by the 15 or 16 digits on your card, not the actual card product itself. So when you do a product change, you're getting a new card, but your number remains the same. If the account number itself changes, there's a good chance you will lose all of your credit history. So it's good practice before you decide to do a product change. Just ask the representative whether or not it will result in closing an account and opening a new one, or if it will just be a continuation of the account that you already have. And third, you could simply keep it open and use it about once every 6 months to keep it active. Otherwise, the bank may close the account due to inactivity. And I used to say use your card at least once a year to keep it active, but I've now switched that over to once every 6 months on average, simply because I had a situation where Wells Fargo closed out one of my cards due to inactivity, and that was my oldest card ever. I think I lost like 10 years of credit history. And that occurred after I had not used my card for about 9 or 10 months. So since that occurred under the 1 year mark, I now just have a general suggestion of once every 6 months or so, put a small charge on all of your inactive or rarely used cards if you want to preserve their account history and not have to put too much effort forward. And on top of that, I do have one more recommendation. In general, I do recommend that you keep every card open for at least 1 year. And the biggest factor behind that is that banks could take back the welcome bonus or freeze or close your account or multiple accounts if they believe you're gaming the system. So if you want to avoid the chances of having your sign-up bonus being clawed back or your account being frozen temporarily or closed permanently, then just keep every card that you apply for open for a full 12 months before you decide to make a decision to cancel or close. And with all of that said, if you enjoyed today's video and believe it could benefit others, then please help me get it in front of more people by liking this video, subscribing to the channel, and turning on notifications. Then check out the links down below in the description area to apply for a new credit card, to get a couple free stocks from Webull, and even some additional cash back when you shop online. There's a whole bunch of great stuff down there, so be sure to check it out. And to wrap things up, I'd love to know which situation all of you are currently in right now with your credit journey. Are you in scenario 1 where you're building for the first time in those first 1 or 2 years? Are you in scenario 2 where you're kind of in the mid-game with a relatively solid score and a good amount of credit history? Or are you in scenario number 3 with at least 5 years or more of credit history, tons of credit to your name, and now it's all about getting as many rewards as possible? Whichever one you happen to be in, let me know down below in the comments area. Thank you all so much for tuning into today's video. I hope it brought you some great value. I'll see you again in future videos, and until then, remember, you are great. By the way, this was an authorized user card, so no, I did not close my account.